gentlemen, it's my pleasure to be here with the investor panel. We've got J.P. Geygan from GVI, Global Value, Hugh Crooks from Ridgebury, Richard from Castlewood, and John Wessel from Oldendorff. If each of you could spend a minute and tell us starting with JP, tell us about your investment philosophy or approach.
Sure. Thanks, Jim. Global Value Investment Corporation is a fundamental, value-oriented, long-only, separate account manager. We deploy patient capital to build generational wealth at our core. Our investment philosophy rests on a few simple pillars. Number one, that in the short term, prices are inefficient, which really creates opportunities for us to buy and sell public equity. But number two, we believe that a long-term time horizon is really important to consistent long-term performance. Number three, our due diligence process is highly quantitative. We really are students of financial statements and live in a balance sheet, an income statement, and a statement of cash flows. But number four, we marry that with a qualitative overlay, and we often summarize that as people-run businesses to emphasize how important it is to invest with good management teams whose interests are aligned with ours. Number five, we concentrate our efforts on a small number of high conviction investments. Our equity portfolio right now has about 18 names. We do that so that we can really study each of those names in depth and develop an information advantage that we believe translates into alpha. And then number five, we believe that when we own equity, we really own a piece of an operating business. And that means that as owners of that business, we have rights. And as owners of that business, we should be operationally engaged. So if we believe that a board or management team isn't acting in the best interest of shareholders, we are not afraid to agitate for change and make sure that they keep our interests where they should be. Over our history, we've been somewhere between 20 and 30% invested in shipping names. We like the industry because A, it's simple for us to understand, although I don't want to minimize how difficult it is to operate a shipping company. B, it's a huge part of the global economic machine. And C, we just find a lot of really interesting investment opportunities.
Hugh, your investment approach is different.
Well, I don't know. I think we're the aligned management team that you're looking for. Ridgebury been around a little more than 10 years. We are ship owners, but we are really investors. So we've invested about $650 million in the last 10 years, 8 separate investment groups of ships with a particular thesis, particular investors. My partner and I put money into everything that we do, and we take advantage when we get a spike or an opportunity to make money for our investors. So it was a pretty rough period. Often in the last 10 years, we made money every time, and we've got sort of a compounded weighted average return of about 19% for our investors over that period.
Yeah, I am an RIA, a registered investment advisor, and I manage money for a few high net worth investors and my family. I'm a generalist, although I have heavy exposure to shipping debt and equity. I invest in public companies with a private equity mindset, which is a 6-month to 2-year time horizon. And what I look for the most is asymmetry of returns, which I would define as 10% of downside and 30 to 50% of upside on my positions.
Hi, John Wessel at Oldendorff Overseas Investment. We invest in tonnage, have done so for the last 60 years, containers, tankers, bulkers, but mainly like the workhorses of the industry, so Handys, bulkers, Kamsarmaxes, medium-range tankers, and smaller feeder and larger containers. We means the Oldendorff family plus investors, depending on the structure, stakes ranging from 25 to 50%. And, well, yeah, we are classic tramp owners, so we do everything on our own, technical management, commercial management. And I think since we have Excel since the 80s, our IRR is worse than yours. I think we're at 16, so.
It's not bad since the 80s. Had a few.
And can everyone hear us okay? Or do we need to be closer to microphones? Closer, okay. There we go. So we have an election coming up in exactly 3 weeks. I'll start with Richard. Does it have any impact on your investment thinking?
Of course it does, and it creates opportunities. And I'll give you the example of the big macro trade, which is going long Argentina and going short the UK, because you have extremes. In the UK, you have socialism and aggressive use of renewables. In Argentina, you have a capitalist. In Malay, you have the Vaca Muerta, I think that's how it's pronounced, which is as rich as the Permian, and they are embracing conventional energy. So, based on the political philosophy, you could go long one country and short the other. I don't know what's going to happen in the U.S. election, but in a strange way, if you own oil assets, you want Kamala to win, and if you own LNG, you want Trump to win, because Kamala, all else being equal, because Kamala, I think she's going to have a radical EPA agenda. I don't believe her on fracking. I look at her EPA appointments, and they're at the extreme from California. They're going to shut down U.S. oil production wherever they can, and that means if you own assets, you own oil, it's going to be very bullish because prices are going to go up. On the other hand, if Trump wins, as was pointed out to me this morning, the easiest product to sell from the United States is LNG. And if a country doesn't want to face tariffs, then they can buy LNG. So we could have an LNG boom. But no one calls me from either campaign, so take that for what it's worth.
And Hugh, how does it move the needle in the tanker segment?
I think it's a mistake to try to make these kinds of calls. I don't think any of us predicted that there would be a lifting of the U.S. export ban under an Obama administration, right? I know it was Congress that did it, but it's these things that that happen. I think both parties react pretty quickly to feedback. If you believed all of Trump's policies, there would very clearly be inflationary, and I think there'd be a pretty fast feedback loop. And I don't disagree with you in terms of perhaps what the Democrats would like to do, but I feel like that the American people have sort of spoken loudly about the sort of pace of energy transition and things like that. So but I think mostly just if you look around and see people who make big, bold macro calls when it comes to buying vessels or things, and we're in a different business from Richard, and our time frame is different. I think you make a mistake. I think you've got to stick to your fundamentals and really understand where your risk is going to come from and how to manage it.
And JP, how does it affect your thinking?
No matter who wins, half of America is going to be mad. So in the short term, we see volatility. I don't think that's all that meaningful or all that consequential. In the long term, I agree with Hugh that there's a robust feedback loop and that pragmatism will prevail. So do we think about it? Yeah, definitely. Does it matter? I don't think that much. And really, for all the kind of political developments we've seen over the past several years, real policy making and implementation seems to move at a pretty glacial pace. That would maybe take longer than 4 years, and again, be pragmatic at the end of the day.
And John, does it matter to you?
Not much to add. I think for us, we also don't think it has a massive impact. We are, in our view, already in a decoupling kind of situation, which has been mentioned on the panel here before, and it doesn't matter who's going to go into office there. I think the future will hold tariffs, subsidies, whoever is going to win, and that will have the discussed impact on shipping. But don't have a major impact.
Listen, my big takeaway from this last question was long Argentina and short the UK. I like that. Okay, tankers. Most investors like it. Most owners like the segment. So, JP, what could go wrong?
I think there's been a great setup for tankers the past couple of years. The toll of geopolitical upheaval aside, the bifurcation of the global trade from the Russian-Ukraine conflict is very interesting. Kind of what's going on in the Middle East makes things very interesting. The order book is still attractive. So I think the setup is there. There's this concern about demand, and we think about how oil exporting nations use production as a geopolitical tool, as something that could be a fly in the ointment there. But overall, over the next 3 to 5 years, I think tankers are a pretty good place to be.
And Hugh, I'm going to add an additional wrinkle to the same question, which is the second-hand market for the older vessels is being held up by a much smaller number of trades this year than it was a year ago or 2 years ago. Should we be concerned?
Yeah, I think that's really the big risk here, right? To sort of phrase it simply, in the past when we would buy a vessel that's, say, 13 years old, we'd say, okay, it's got 7 years more or less of useful life. It's going to be worth scrap at the end of that. So what rate are we underwriting that we're going to have to earn over that period for a decent return? Does that make any sense? And then within that, you get volatility, you get a spike, you sell it, you do better than that. But that's sort of your longer case. And that's where, you built or bought a ship when it was new. At the end, you sold it for demolition or something close to that at 20. An MR, for demolition is worth $5 million. A 19-year-old, almost 20-year-old MR last week was sold for $19 million with survey due to undisclosed interests. The brokers and everybody are marking these vessels as though they're worth that, and they're only worth that to some people who can trade them differently from the way the rest of us can. So I think it would be like if we were sitting here, we're all New York apartment owners, and the value of New York apartments are kind of based, or historically been based on what people earn and what you can afford to spend on rent. And then all of a sudden, like a small number of people are able to run them as very lucrative Airbnbs. And so if I come in, I want to buy an apartment, I can't buy one because I can't compete with that. I want to live in this place. I only make a certain amount of money. Somebody else can make a whole lot more money. Everybody who owns an apartment, all of a sudden they're kind of excited because now their apartment in theory is worth, that was worth $1 million, now it's worth $3 million because it's being kept running by this because it's a very now small number of transactions that are happening. And the brokers all mark them that way. Clarkson's marks them that way. But if you had to sell a fleet, that is not the liquidation value of your fleet or anything close to it. And so I think as this trade eventually settles or unwinds, or, I don't think it can continue in kind of the way that it goes indefinitely. There's some benefits for tanker owners longer run, and I think for people coming in it'll be good, but I think there's the possibility for a really harsh repricing of the fleets that tanker owners have. And that runs from the old, and then it just kind of runs all the way back up to the top.
And let me jump to John on this question next.
Unfortunately, I can only fully agree. Now it's our time to sell as classical tramp owners, and we have done so. And selling a tanker in this market takes us up to half a year because over 3/4 of the buyers don't pass KYC. So I fully agree with your pricing question, and I think, we also don't see the reason why Schenkers should go down. But if you're not in now, I think it's too late to follow that train.
And Richard, tankers, what can go wrong?
I'm a stock jockey. So these guys operate businesses. So if I change my mind tomorrow morning at 8:30 Dallas time, I can sell my entire position. It's different decisioning. The other thing is that equities and owning ships should converge over time, but they don't have to, and the variances can go on much longer. And what's important for a stock is the narrative as well as the actual rate market. And to me, the two things that I'm afraid of for tankers, but the same outcome, is that there is a spike for some reason for 2 years, and Vs are earning $150,000 a day. And, I can assure you people will order Vs like crazy and destroy the market. The other is if net zero goes away and people decide, hey, we can buy more tankers cheaply, and they overorder. And what kills shipping cycles for equity investors is overordering new vessels.
So I want to, my next two questions I want to thank Richard for. So I'll start with JP. What are we worried about today that we shouldn't be?
I'd go back to the U.S. election. I think fear over that is overblown, that over the next several months, we really don't see a lot of upheaval around that. We are somewhat concerned about how America is, or the United States is understood to its global allies based on who wins and our kind of commitment to treaties and agreements we have worldwide, and then the long-term geopolitical implications of that. But beyond that, again, I think markets and economies are really going to be the determinants of policy at the end of the day, and politicians are pragmatic about that.
And Hugh, what are we worried about today that we shouldn't be?
Actually, Richard, why don't you go first?
Okay.
Yeah, so you asked the question. Presumably you're ready to
question.
answer it.
No, I had to really think hard about it. And, people have been worried for the last year and a half about China invading Taiwan militarily. And I think they're taking it over slowly. And they have long time horizons, so there's no reason to invade China, for China to invade Taiwan today. Okay.
Yeah, that would have been my point, funny enough. I don't think there's going to be an armed conflict with Taiwan. Nothing else to add on that one.
Yeah. I don't know. Everything I hear about when someone says you should worry about this, I think, yeah, you're right.
All right, so let's take the other question. What aren't we worried about today that we should be?
I think somebody mentioned it on an earlier panel. I think we perhaps should be a little bit more worried that we evolve back into sort of a bipolar world. That some U.S. particularly, we've used sanctions, and how effectively, in terms of like actually changing regimes or things, not that effectively in terms of punishing economies maybe more. But then we've sort of got to a point now where we seem to have driven some powerful people to rethink how exposed they want to be to that threat coming up every once in a while. And so you do sort of see there's always this assumption when sanctions drop on Russia or when things run straight back to the way they were. And the question that's always posed is, are these ships going to be allowed back into our system? And I think the question of China, generally they like to control things, and now they control a lot more tonnage. They control a lot. And so sometimes it's happened in certain sectors before, but it may happen in others where sort of the independent Western owner gets frozen out a little bit, and our world gets a little bit smaller, and you mix that in with, anti-China, negative rhetoric, other things, and we've had generally global tailwinds for several decades in terms of, globalization, reduction in tariffs, disinflation, and if we see a reversal of that, we'll still have our spikes, we'll still have things, but we could be just overall facing a more hostile environment.
Richard.
Okay, what Hugh is worried about, I would consider that to be an opportunity, because in an inflationary environment, you want to own ships because they're real assets and they increase in value. And I can tell you, if people can't use Chinese shipyards, prices are going to go way up. And if you own secondhand tonnage, you're going to be very lucky. Although, from a personal standpoint, I agree with Hugh. I mean, my big concern is the industrial collapse of Western Europe, and that Western Europe is fast becoming not an economy, but a tourist destination. They don't have armies, they don't have manufacturing, they don't have industry, they don't want to pay for their defense, they want to go on 6-week vacations, and they don't want to get emails after 5 o'clock and on the weekends. And however, they expect Americans to pay for their defense. And I think if Europe doesn't turn around, it's going to become more and more politically impotent. On the other hand, it's also great for shipping, because if they don't manufacture things, they don't buy things, they're going to have to import them from China and the United States, and it's going to come on ships.
I'm glad this conference isn't in Oslo or London.
Yeah, right. Yeah. Being German, that's great to hear. Yeah, I love it. But unfortunately, I think you're right. Maybe one thing to add on the what we are not worried.
You're going to accept them, saying that you don't make anything, you don't manufacture anything.
Well, we
work past 5.
We do at the moment, but the question is for how long, and with what sort of energy, and with what sort of operational workforce. And that is actually another point, what I think we should be worried about, and that's away from the macro, but I think this is often forgotten by especially Wall Street, that these shipping businesses are operational businesses. And I mean, the majority of our technicians are 55 to 60 years old. And these guys actually work, keep the ship running, and there aren't hardly any people left to do it properly. And if you have one day off hire in such a market, you'll regret it very quickly. So I think there is a bit of a question mark where the people are supposed to come from in the future.
And JP.
Along the same lines as Hugh, we worry a little bit about kinetic conflict, and we've seen the disruptive effect that has had in shipping in the Middle East after Russia invaded Ukraine. And the widening of a conflict in the Middle East could really have some catastrophic consequences for global trade flows. I agree with Richard that the Chinese are calculating and very long-term focused and are going to take over Taiwan slowly, but I think there is also a possibility for miscalculation with the Chinese and maybe some of the entangling alliances that you have seen develop in various parts of the world. Very much kind of a bifurcation between this bipolar world that would not be a favorable thing for trade flows and shipping, in my opinion.
All right, I'm going to make you all think like Hugh now. I'm going to give you a 5-year horizon. Start with you, John. What would you buy?
Well, right now, I said
But you have to own it for 5 years.
Okay. And I have to buy it today. I can't already own it.
Yeah, you'd have to buy it today.
Yeah, okay.
or buy it from yourself?
So last time I was kindly enough to be invited on such a panel, I said that right now is a very bad moment to invest in shipping tonnage, and I stick with that. If I'm being forced to do so, I would follow our previous panel and look for smaller bulk vessels, ultras, perhaps Kamsarmaxes, because ultimately I do see a healthy supply demand there. But I think 2025 is not going to be a good year. So if I could avoid it, I would avoid it. But if you make me there.
Richard.
Okay. I want to take a hold harmless for a minute that, I tell people if you want weekly, monthly, or quarterly.
You got to sit forward here, Richard.
If you want monthly, weekly, quarterly returns, I don't have a clue. And I'm looking at 6 months to 2 years. For 5 years, I clearly like SFL. It's yielding 9.4 to 9.5% right now. They have long-term charters, excellent management, and importantly, risk control. And the way I think about it is that if you look at the long-term return of the S&P 500 over the last 3 years, it's 11.79%. And if I buy something like SFL, I'm getting 9.5%. So it means I really only need 2% capital appreciation to have an equity-like return, and I feel that I'm having significantly less risk. Another way of looking at it is if you look at high-yield bonds, the spread versus treasuries is extraordinarily tight, and I can't find anything in the high-yield space that's not going bankrupt for under 3 years for more than 5 or 5.5%. So if I'm getting 9.5 for a company that I think should be a double B or triple B, with a double B or triple B balance sheet, and I'm earning an extra 400 basis points, I'm happy with that.
Hugh?
Yeah, I think we're spending a lot of time on this right now, and I think you have to think like an investor. Richard, I think you've mentioned the money that you do manage externally. It's always a small percentage of somebody's portfolio, and I think shipping has a couple of really interesting traits that way. It really isn't correlated with almost anything else, and there is a big risk in today's investment. Everything is becoming increasingly correlated, and shipping among the different sectors not correlated at all, in fact, and you think it would be not correlated to the underlying commodities. Iron ore and dry bulk don't correlate, and also has two other things going for it. One is a real right tail skew in returns, and so if you have flexibility, if people have mentioned it, don't get forced to sell at the wrong time. Control your exits. You take advantage of that right side skew, and it tends also to kind of negatively correlate in crises. We do. People always say it, and if you look back at it, it's true. Often a crisis that causes other sectors of the S&P to do poorly is good for shipping. So I think if you're an investor and you sort of are thinking of it that way, it's not. I'm not going to put all of my money into an LNG new build, but I'm going to construct a shipping portfolio with a combination of some really strong yield, whether that's publicly the way you are, or certain asset classes right now. Notwithstanding what I said about some asset price risks, that the cash on cash yields in tankers are tremendous, and you build some of that. Some certain segments in containers, and there's reasons to hate containers, but there have been some surprises there as well. And then I think over time you have to pick your your spots for the bigger sort of beta plays, and I'm not sure I see any of them right now. I think we could be a bit closer in dry bulk on that. But essentially, I think you want to build up a really strong back-tested portfolio that's going to, perform okay. You look at your different sectors. What if they return to long-term averages? What if they turn to lowest quartile? What does your skew look like? And I think you can build that, negative 10 to positive 30, 40% that Richard was talking about. But I think that's the approach that you'd have to take today, rather than this is the time to go all in on whatever that single class might be.
The only one who can really call markets is John Frederickson and Bob Burke. And Bob Burke isn't here today. But, Hugh is a great replacement. But, no one can time shipping markets. And the great thing about what Hugh and John are doing is if you're willing to commit capital, your returns may be more volatile, but at the end of the period, your RRRs on your Suezmaxes were, 30 to 40%?
Yeah, it depends. We didn't get them all right. I mean, you've said that before. Anybody who tells you that they buy at the bottom and sell at the top is not being truthful, or we're lucky ones. And so we've had sometimes we've worked our tails off to get a 6% return, and then other times you get a little bit lucky. I mean, again, and it still goes without saying, hate to say it, you get lucky because Russia invades Ukraine, and all of a sudden, that was not in your investment thesis. But that's where I say if you stick to your principles, these disruptions that come along do tend, to favor you. You need to make sure that you can take the body blow of a negative disruption and that you're positioned to harvest a positive one.
And JP, 5-year perspective.
Well, as a public equity investor with a 5-year plus time horizon, this is an easy one for me. I would say dry bulk. We are a big believer in long-term global growth. We employ 2 analysts in central India, so we have a front row seat to the kind of explosive growth that we expect to start to materialize there in the next 5 to 10 years. And I think dry bulk is a very good bellwether for global economic growth. It would stipulate that I think investing in all sectors of shipping, you need to really hitch your wagon to the right management team. So I would encourage any investor to evaluate a management team's track record, their capital discipline, and then how well they stick to that capital discipline over time. Frankly, in dry bulk, we like companies that make large dividend or return from principal distributions in order to kind of de-risk the investment over time. So you might be able to see where I'm going with this, but that'd be where I want to be.
All right, we're running short on time, so let's just go down the line and give me, for the next 12 months, your favorite long or your favorite short, starting with JP.
Well, after lunch, I'd say the Panama Canal, but we're long 2020 bulkers, and I like that. We are a long-only manager, so we don't really have any shorts per se, but we did recently exit all our container positions, so that's probably the closest thing I can say to short.
You.
Well, notwithstanding what I said earlier, I am personally very long.
China.
Tankers, and I guess this is where I'm a little bit closer to Richard. I think there is still, there's volatility. There is still tremendous, cash on cash returns there, and so that's something that's worked really, really well. And on those, I like, I like Frontline, quite a bit because I like V's, and they're the only ones out there who still have some leverage, and so I do like that. But as I said to my earlier hedge thing, I think I'd put a little DHT on top of that with a little less volatility, and then I think the guys at Torm have done a really, really good job, and they consistently generate high returns.
Richard.
Yeah, I like Flex, Navigator, and Starbulk. All 3 have asymmetry of returns. Navigator has an investor day, November 12th and 13th. You're going to get an ability to tour their Morgan's Point facility, and the analysts haven't incorporated the income from the Morgan's Point expansion into their estimates. Flex, you've got charter coverage and a yield of 12%. And I agree on Star Bulk and dry bulk in general. The stock is trading at liquidation value. You've got dividends, you've got low leverage, and I'm patient, and I think there's upside. As to shorting, I don't do that, but if you shorted at anything that I bought in the last 2 weeks, you made money.
And John?
I'm really not an stock picker here, but I would follow and say that containers are probably not. I wouldn't invest in containers. Let's put it like that.
Hey, Jim?
Yeah.
You're good at this. What do you recommend, and what would you short?
I like Golar, and I think that the LNG value chain gives you a lot of value, even with the vessels. So if you look at the LNG tankers, for instance, they're trading at sort of 55 to 70 cents on the dollar of NAV. They're paying you a double-digit % dividend. They've got, for the most part, the two listed vehicles here, they've got contracts that take them through 2027 and beyond. And so to me, they're just mispriced utilities, but that's not the piece of the equation I like better. Regasification to me is cheap if you look at something like Accelerate Energy. But to me, the most exciting part is the liquefaction. Thank you. And Golar, to me, once they get this next asset in place, the EBITDA that they'll generate will be spectacular. So that's my personal pick. On the short side, yeah, I'm in the container camp. All right. That's enough. Thank you very much. Gentlemen, thank you.